What if I told you that some of the biggest market crashes in history didn't begin with bad news? They began with good news. Too much good news. Because bubbles don't start when people are scared. They start when people stop being scared. In this video, we're going to break down the basics of investing through one of the most important ideas in finance, how bubbles form and why markets crash. And more importantly, how understanding this can make you a smarter investor. A bubble is when the price of an asset rises far beyond its real value, mostly because people expect it to keep rising. That's the key mechanism. Expectations feed on themselves. If a stock, house, crypto coin, or anything else goes up enough, people stop asking, is this worth it? And start asking, how do I not miss out? That shift from analysis to emotion is where bubbles begin. Most bubbles follow a similar pattern. First, there's a real story. Maybe a new technology, lower interest rates, or a booming economy. Then early investors make money that attracts attention. More people buy, prices rise further, and rising prices themselves become the evidence that the story is true. This is called a reflexive cycle. Higher prices create more demand, and more demand pushes prices higher. It feels rational in the moment, because everyone can point to a chart going up. But a chart going up is not the same as value going up. Bubbles are powerful because they exploit human psychology. We hate missing out, we copy crowds, and we tend to believe recent trends will continue. If an asset has doubled in a year, people assume the next doubling is just around the corner. But markets don't move in straight lines forever. Eventually, prices get so high that new buyers run out. At that point, even a small disappointment can trigger selling. A crash is usually not caused by one giant event. It's caused by confidence breaking. Once people realize prices are too high, they rush to sell before everyone else does. That creates a feedback loop in the opposite direction. Falling prices cause panic, panic causes more selling, and more selling drives prices even lower. This is why crashes often move faster than bubbles. Going up takes enthusiasm, going down takes fear, and fear is much faster. So what's useful here? First, don't confuse popularity with value. Just because everyone is talking about an investment doesn't mean it's a good one. Second, pay attention to price versus fundamentals. Ask, is this company actually growing earnings? Is this asset producing anything real, or is the price mainly rising because other people expect it to? Third, manage risk. Don't put all your money into one hot idea. Diversification won't prevent losses, but it can prevent one bad bet from wrecking your portfolio. For example, if you're looking at a stock, compare its price to revenue, profit, and future growth. If it's a house, consider rent, location, and affordability. If it's crypto, ask what problem it solves and whether adoption is actually growing. And if you see an asset rising dramatically with no clear explanation except everyone wants in, that's a signal to slow down, not speed up. Bubbles are not just financial events. They're human events. They reveal how powerful optimism can be and how dangerous it becomes when it turns into certainty. If you understand that, you're already ahead of most investors. Because in markets, the hardest skill isn't predicting the next big winner. It's recognizing when excitement is becoming irrational before the crowd does. And that insight can save you from one of the most expensive mistakes in investing. Investing basics. How bubbles form and why markets crash is just one small part of the stock market. Bubbles, crashes, and investing basics for students interested in economics. If you're interested, our full Free the Stock Market, Bubbles, Crashes, and Investing Basics for Students Interested in Economics course is linked in the description.